Morning, guys. It's Thursday, November 13th, 5:24 a.m. Central Time. Grain markets are mixed this morning. Soybean futures did post some fresh highs overnight. Brian Split is here. I told him he looks like a drug dealer or maybe an undercover cop. I don't know.
I'll go the undercover cop route.
Before we get into the news today, we have a couple of shameless advertisements to do. Brian, your group, Ag Market, is holding its annual meeting here in my backyard in Nashville, January 31st through February 2nd. Tell us about it. Tell the people how they can sign up.
Yeah, it's a great conference. This is I think the fourth year that we've done it in Nashville. Everybody seems to have a great time there, but the focus is on really focusing on your operation and your inputs and not so much on what the market says. You know, $5 corn is not the same for everybody. So really want to focus on your operation. We do have some very high level economists. The CME Group chief economist is going to be there with his 50,000 foot view. We do have some commercial input from JSA, so producers can get in the mindset of how commercials think. And we're going to have myself, Matt Bennett, and a few other guests. Joe and Mackenzie, you guys will be there. And it's if nothing else, it's a good time, but I think it's very educational. But just go to agmarket.net. There's a banner at the top of the website, and it'll take you right to the registration page.
Very good. Quick ad for the premium subscription. Brian, you were on yesterday with Mackenzie, and we've got a lot of charts in today's podcast. But yesterday, Brian went into great detail on the soybean market in particular, among a bunch of other things. So give that deal a shot. With that, let's get into the news, and we're going to start with the soybean action.
So soybean futures posted fresh highs overnight. The January 26 contract rose above $11.40 per bushel for the first time this year. On a continuation basis, the market traded at its best level since July of 2024. Meanwhile, the December 25 corn contract rose 3 cents on Wednesday, closing near $4.35 per bushel. Traders are anticipating downward revisions to this season's yield and production estimates from the USDA on Friday due to dryness and disease that have reportedly affected crops across the Corn Belt. Wheat futures also finished higher yesterday.
Brian, we've got a story on China coming up here in a minute. Let's stick to the technical piece here. So on this January soybean contract, you got a couple of gaps. You got fresh highs overnight. It looks awfully damn good. When you look at the weekly chart, all of the losses associated with the trade war have been erased. We're higher than the soybean market is higher than it's ever been since Trump has been in office this time around. What are your thoughts as far as the charts are concerned?
Joe, so far so good. The market has done the same behavior twice with these gaps. That first instance, that gap was bigger than the second gap, but we, gapped higher, went up. We pulled back, and we right to the low of the session that we had gapped higher. We kind of rechecked that, and then away we went. Then we did have the surge to new highs, pulled back. We had that second gap higher. The next day we pulled back, went kind of right to the opening price of the day that we gapped higher, closed off the lows, and here we are making some fresh highs. So if you forward to that next one, this is the daily. Let's go to that weekly continuous. What's going to be really interesting, and we discussed this in the premium video, but the November contract does expire the day of the report. That's the Friday session, and then the January contract then becomes the front month, and there is carry in the market. So what's going to happen is November is going to leave the board, and then January is going to become the front month contract in a new week next week. And you are likely to see a gap, at least to start the week. Now, what's interesting is there's a gap lower. If you draw your eye left to July of 2024, there's a gap lower, and that gap was not closed. That's at 1134.5. So as we see November leave the board and January become the front month contract, to start the week, there will be a gap, and potentially it could be right in the same zone of where we gapped lower 16 months ago. That would give you a weekly island bottom if it lines up just right. So it'll be something we'll be watching very closely into next week's trade. But if you have that type of a weekly island bottom on this chart, that would then really accelerate the bullish look of the way this market's trading.
I threw in a corn chart, and I added the 200-day moving average because it appears to be very important. We've tried to break through it, but we haven't been able to. That's been kind of the big hurdle.
That, if you also look at the premium video, we went over behavior of corn last year and how important the 200-day moving average was to that next leg of the rally, if you will. And then this 200 days should provide resistance But until you get through there, and if we get through there, then that does multiple things. And if you kind of think about this December contract's going to go into delivery. So if we think about the big picture of what might happen over the next few months, we think about that March contract. March also has been failing at the 200-day moving average, and it's just about 450 on March. That also lines up with a 50% retracement of the whole break from February's highs. That's the high for the year down to the August lows. That's the neckline of this head and shoulder pattern that we've been talking about. And I think this last leg, so if you look at the lows that were made in October, and I'm like pointing at it on my screen, like you guys can see me pointing, but you had a 2-week rally, and now it's been 2 weeks of just sideways consolidation. That would be a definition of a bull pennant. And so now you've got a head and shoulder bottom potential, you've got a bull pennant potential, and everything just lines up where if we get through this 200-day moving average, we should then see that become support. And I would venture to say that the technical buying will accelerate. Now, we could very well pull back. I think the 100-day moving average is right around that uptrend, right around 420. So if we don't get through the 200-day, I do expect a test of the uptrend, test of the 100-day, and then maybe from there we go back and check the 200-day again. But the 200-day is absolutely critical.
I've always been told, and we have no way of really knowing, but I've always been told that fund traders watch this 200-day very closely, and that it's kind of an indication of just the general trend, and it can change their thinking.
Correct. And I think another moving average to watch when a market is trending, which admittedly, the soybean market really has not been trending in a direction for the last 15 months or so. It's been sideways. And if you look at the 10-day moving average in a market that's really starting to build a direction, it's starting to build a strong trend, the funds will very often defend that 10-day moving average. So, I would venture to say, guys, pull up a Jan soybean chart and put the 10-day moving average on there and see how that moving average has been support every time we've seen some drastic pullbacks on this, sharp rally. There have been some pullbacks, and they keep buying the 10-day.
Chatter about 2026 acreage plans has started to emerge.
I have my copy out of order here. Excuse me. The U.S.-China trade truce will likely influence next year's soybean acreage. Ed Usset, a market economist at the University of Minnesota, said the agreement is positive for soybean demand and prices and is likely to support an increase in planted acreage next year. He noted that soybean futures have reached their highest levels in over a year, and that basis levels have strengthened since the deal was announced. Usset also highlighted the rise in domestic soybean crush. He believes the market may not yet fully recognize its strength, drawing a comparison to the surge in ethanol demand 15 to 20 years ago and its impact on the corn market.
That's Ed Usset, Mackenzie, who
Sorry,
I know you don't know him, but I do. He's been on the podcast before. He's a good dude, sharp dude. Okay, Brian, Nov 26 soybeans. Look at this, pretty good.
Yeah, fresh highs for the move here overnight. This market continues to trend higher. We have one gap, so we have that one breakaway gap. We don't have the second gap that the old crop soybeans have. But this is another market that has shown the desire to maintain price action above $11. Again, it's not the front month contract, so it's not the one that we are focused on when we really think about that price of $11. But nonetheless, it is a contract that's made its way above 11, and we'd like to continue to stay above 11 here for a while. Should have very, very good support on pullbacks to that 1090 area, that those old highs from June and September. But when we think about the acreage implications, we're already in a year anyway where we should see the soybean acres go up year over year just because of the rotation, right? This was a very heavy corn acreage year, a low soybean acreage year. So now we've got the rally in the soybeans. Not that corn hasn't gone up, but obviously we've seen this market kind of stall out here, and we're not making new highs for the year like we are in soybeans. So soybeans have taken leadership of this rally. I do think that this is something that then leads to a potential bull market later in corn, because once you have a scenario where acres aren't in the ground, if there's any additional demand that pops up, if there is a weather issue, you just can't get those acres back. So that might be something that is seen as friendly down the road. Plus, we have a major input cost problem. And that goes for both corn and soybeans. They're not cheap to grow, considering where the futures value for these products are. So I think we've got some additional upside that needs to happen in order to make things right.
When you look at the ratio, it probably still slightly favors corn, and the early farm budgets that I've seen would indicate that D's 26 corn is a lot closer to production cost than Nov 26 soybeans. Production cost for corn next year, ballpark, according to Chris Barron's data, I think is somewhere in the 460s or 470s. So you're probably close right now with D's 26 corn, where farmers can at least break even. Whereas soybeans, I think production cost for 26 is probably estimated somewhere just south of $12. So I think it still kind of overall favors like a lot of corn acres, but are you going to see, 98 million again? I don't know about that.
No, and it's a fluid situation, but I think after seeing 97 plus 1 year, just it's a back to back, it's a back and forth. Just look at
Yeah.
a balance sheet and look at
Yeah.
the planted acres year to year to year, and it does ebb and flow, opposite directions each year. How much we see, leave the corn acreage and go into soybean acres, I don't know. I would tend to think it should be at least 3 to 4 million, but we'll see how everybody's numbers come together in the next few months.
Yeah, it's all changing in real time, so we'll see. Okay, now we can talk about China.
So, after a brief round of buying following last month's trade truce, Chinese imports of U.S. beans have come to a halt. There is now uncertainty over whether Beijing will fulfill its pledge to purchase 12 million metric tons of soybeans by January and 25 million metric tons annually over the next 3 years. Keep in mind, China never officially confirmed these commitments, and many analysts view them as more of a diplomatic gesture than a binding agreement. In the near term, Chinese demand is expected to ease following significant purchases of Brazilian beans, which have boosted the country's stockpiles. U.S. soybeans continue to face a 13% tariff in China and are currently trading at a premium to Brazilian supplies.
All right, Brian, we talked about soybean price action. We've erased any losses associated with the trade war this go around. The question now is why? Why are we rallying even though China hasn't? I think they've bought something, but I don't think it's been nearly enough or anything close to the 12 million that we were promised. So the why is the question.
And that's one of the most interesting parts of this whole conversation, because it does appear that everything that we think we know appears bearish, right? We think we know that there's a 175 million ton or more crop coming out of Brazil that's going to be online here shortly. We think we know that prior to the government shutdown, the export pace for soybeans was not at the pace needed to hit the USDA goal. We think we know that the Chinese haven't really been purchasing in mass. But somebody's in here buying right now, Joe, and I don't think it's just the funds. And I wouldn't be surprised if we find out down the road that soybean purchases are announced at higher prices, yet the Chinese have actually been long the whole way. They can be long the futures market, and then announce purchases later, convert those futures sales to purchase or futures purchases to actual real world purchases down the road at much higher values. And then what's going to happen is we're going to get all these headlines that China's buying beans, and the market's already going to have gone up several dollars. And everybody's going to say, oh, we need to buy this, China's buying. And then that's when they lay off their futures and the market will correct when everyone else is trying to buy it. That's how the market behaves. So I think this is a really interesting and unique period, because we just don't have government data either. So we don't have export sales. We don't have commitment to trader data. We don't know who's doing what right now. All we have is what the market is doing itself. And I think it's telling us a story.
I have heard the same thing. I've heard that Chinese interests are buying futures, and I know for a fact that Chinese interests trade the board and in significant fashion. We have no way of tracking it. Like there's not a China category on the CFTC report, right? But I've heard that, and it would make sense because there's not much in the cash market that would indicate that China's sniffing around for beans right now. Like people have been talking about PNW basis, so there's nothing going on there. It's not indicating that they're in buying. But could they be buying the board? That makes sense, doesn't it?
Yeah, and there's a soybean option market maker that I follow. I'm sure you follow. His handle is at MSG Capital. And one of the themes over the last several months has been the selling of puts, right, by the thousands. And he will often, when he says X thousand $10 puts sold at this, then he'll have a little Chinese flag, or he'll have the asterisk hungry piggy capital. And so I take that as it's the opinion of this market maker that's been doing this for a very long time. And when you see pictures on his Twitter feed, it's generally of him and his wife traveling the world, right? So he's good at what he does. And I think the Chinese have been selling thousands and thousands and thousands of puts below the market, expecting them to expire worthless because they know where they want to buy. So you've got sold put premium that they've been collecting. I think they've been long futures. And I think these sales, they have the ownership. They're accumulating the ownership. It's just not being announced as physical sales at this point.
MSG is a sharp dude. He's also a Southsider, just like myself. I'm wearing my White Sox sweatshirt this morning.
Yeah, attaboy.
Notice. All right, we got a report tomorrow.
We sure do. Traders expect the USDA to make a substantial downward revision to its estimate for this season's national corn yield and overall production. However, the crop is still projected to reach a record high. Soybean yield and production are expected to decline modestly. U.S. ending stocks for corn, soybeans, and wheat are projected to rise slightly, with few changes anticipated in global ending stocks. Due to the government shutdown, the USDA did not release monthly crop reports back in October.
Brian, I believe the corn and soybean yield numbers are the big ticket items. What are your thoughts?
I think so. I think that is the quickest way to see fluctuation in the balance sheet from what our current understanding is. And I think then what happens with yield will likely drive to an extent how the USDA manages the demand portion of it. But what's going to be interesting is, right now the corn demand on the export side does not suggest that we should be seeing any reductions there. I think the prime category that they would adjust lower would be that feed residual. And a lot of that conversation comes from the quarterly stock report that was at the end of September. We kind of forgot about that because we never had an October WASDE report to really rectify those numbers into the balance sheet. But our number for corn, the agmarket.net number was one of the lower estimates. We're at 181.7, so we're down 5 from the September number. We do expect feed residual to be reduced, so that puts our carryout in our balance sheet just a hair above 2 billion bushels. Soybean production, we are 53.3. We do have carryout at 266, and I just think that's a number here where there's, now you're at a point here on the soybean balance sheet where there's not much room for forgiveness if that yield comes in below 53, and 53 is a really, really good bean yield in the big picture, Joe. So if for some reason we start to see yields drop further from there and the Chinese do buy and accumulate more, maybe that's the reason why this market has some further upside.
There are some smart people who believe that this year's national corn yield is no better than last year. Last year was 179.3.
Mm-hmm.
If that's reality, I mean, you probably got yourself a story at least where like corn south of $4 on the board ain't happening again, and you should probably be closer to 5.
Correct. I think that scenario with the what we had priced in the August report going all the way up to that 188.8 type of a number, then seeing potentially, I think you had referenced, there was a survey that was done. Then I think there's a seed company that put out some of their research from their plot surveys.
Yeah, Wiffles did.
Yep, and so those two suggest that yield could be below last year.
Mm-hmm.
And I've talked to producers in Iowa that, and don't get me wrong, there are some producers that did have a very good record crop, but I would say that anecdotally, maybe it's 1 or 2 out of 10, where the other producers are, hey, I'm 8 to 10 bushels below last year because of disease, and those acres got fungicide treatment and still underperformed. So I think there's a big picture story still that is developing, and I think it has a lot of similarities to last year in corn as far as the whys. Why the market build that base in August. We had a very dry August like last year. We have a very good export program, and we're likely to see the understanding of production deteriorate over the next several months.
All right, we've got some news regarding my breakfast this morning.
The Trump administration is considering the removal of tariffs on various food products. Administration officials indicated that tariffs on items not produced domestically, such as coffee and beans, could be eliminated. The proposal follows recent state and local election losses by several Republicans, which some have blamed on rising living costs. Officials have not released specific details, such as which countries would benefit from reduced tariffs. Treasury Secretary Scott Bessent stated that the cost of living is expected to decline by the first half of next year. regarding President Trump's plan to distribute a $2,000 dividend to Americans. Besant emphasized that no final decisions have been made.
I'm going to turn this into a cattle story because this would imply that they didn't mention the word Brazil, but this would imply that they're going to do something with the Brazilian tariffs, which is very high. The U.S. tariff on Brazilian imports right now is 50%. So it's impacting coffee and bananas and other things. And Trump has a fight against high beef prices now. This is one of his goals, is to get beef prices down. So I threw in a couple cattle charts this morning. Mackenzie, do you have any idea what imports of beef from Brazil could do to our balance sheets?
I am not, I can't be exact, but we have always imported Brazilian beef during the first half of the year. Brazilian beef imports were up like 90% year over year.
Yeah.
And we didn't see the cattle market fall apart then. So we shouldn't now either. But I am almost certain, if this does go through, since we have such uncertainty in the market right now, that this will definitely do damage to the market.
Did they import a lot of beef in the first half of the year to front run the tariffs? Was that what happened?
That's a thought, possibly. And then also, I think just to keep up with domestic demand, we have such incredible demand that wholesalers were needing that extra grinding meat, essentially.
Brian, I didn't do much with this cattle chart, but what are your thoughts?
I think cattle's in trouble. I still, when I look at cattle, I try to focus on very big picture and that reversal that we had in the month of October. I think feeders are the leaders. And we had a major monthly reversal in feeder cattle for the month of October. Then that, to me, puts a extreme amount of importance on the September lows in feeder cattle on a continuous basis, which was just under 350. That essentially is the monthly low that let October become an outside month lower, right? October had to trade above September highs and then below September lows in order to forge that reversal. So I think 350 is going to be a major battleground on the feeder cattle prices. We can see very sharp bear market recoveries, but I do think we're at the early stages of developing a downtrend in this cattle market after seeing record highs. And in order to get that downtrend started, we have a very sharp break. We need to see very quick, strong rallies to start building some peaks to build those downtrends from. But I think this cattle market, has a big picture. It probably needs to correct about 20% before we really start to see a major recovery attempt.
Outside markets are mixed this morning. Brian, thank you for joining us. Guys, we'll be back on Friday. Have a good one.